Good evening and welcome to the first session of our Autumn Term Money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I'm Dr. Juan Castañeda, Director of the IIMR, and tonight we'll be hosting James Ferguson. James graduated with an MA in Economics from Edinburgh University. He has over 25 years of experience as a stockbroker, sector analyst, and macroeconomic strategist. In 2013, he co-founded the MacroStrategy Partnership LLP with Andy Lees from UBS. MacroStrategy operates at the nexus between macroeconomic theory and the empirical tests provided by market forces. He previously held the position of Head of Strategy at Westhouse Securities Limited and Chief Strategist at Pali International. He formerly held a variety of positions, predominantly covering the Japanese market at several investment banks based in London and in Tokyo. James is a regular contributor to Money Week since 2004. He has made frequent appearances on the BBC TV and radio news, as well as Sky TV, Channel 4, and Bloomberg TV, commenting on economic, banking, and investment matters. Today, we will discuss, will inflation be temporary or an embedded phenomenon? After which we'll allow time for Q&A with viewers at home. Today's presentation will be recorded and made available on our YouTube channel. Questions must be submitted via the Q&A section, and I will moderate them and address the speaker. Today's seminar is very much at the core of the current policy discussions on inflation and monetary policy, and it will be the main topic of our annual conference on December the 1st. Please visit our website to check the program and to register should you want to attend. Thank you, James, very much for accepting our invite to contribute to our webinar series. We very much look forward to your presentation and to the discussion time afterwards.
Thank you, Juan. Well, welcome everybody. I'm going to ruin the ending of this right from the start, because rather than discussing whether inflation is going to be a transitory or embedded phenomenon, I'm going to explain why I believe it is an embedded phenomenon and explain the discrepancies in the transitory argument and what it is that in my opinion, the Fed staffers are getting wrong. And when I say the Fed staffers, I would have to include Andrew Bailey and his team at the Bank of England as well. But for the purposes of simplicity, although this argument pretty much holds just as relevantly in the UK as it does in the US, I am using the US here as my basic explanatory example, because much of the data is sort of slightly more readily available and easier to display. So the first thing that I would want to point out before we go any further is that the terms of the inflation debate, we tend to think of inflation as CPI or maybe personal consumption expenditure based, and whether that's core or headline. This is nevertheless a basket of consumer goods, and it's missing an awful lot of other things which the prices of which can inflate. So the obvious one to think about here that's completely excluded from any official inflation measures are asset prices. So we have a look at the first slide. This is a representation really of QE and the S&P 500. And you can see that since QE started, this is the red line. So this red line shows the, people often represent QE as being the balance sheet of the Federal Reserve, but it's not exactly the same thing as the balance sheet changes, or it's the main driver. This is specifically securities held outright by the Fed. In other words, QE. So when the red line is rising, we have a period of QE. And you can see that when we have periods of QE, that tends to relate very closely to periods of strength in the S&P 500. So QE encourages a switch from risk-free assets into risk assets. If I showed you the chart of QE and bonds or treasuries in the US, you would see that during periods of QE, Treasury yields rise. This is quite contrary to what the Fed will expected and will tell you to this day actually happen, but it's just a matter of record that when QE is operating, we see that risk-free assets go down and risk assets rise. This is because QE is inherently inflationary, but that is also something that the Fed would not accept. So the main takeaway just for this first section is just to point out that when the QE, in the InterQE periods, these are the areas ringed by the green ellipses, in those InterQE periods, the S&P 500 either fell or basically tracked sideways. So certainly until full resolution of the great financial crisis was achieved, in the absence of the QE inflationary impulse, stocks did pretty poorly or neutral at best. If you have a look at the next slide, we can see that there's a similar story sort of plays out as far as the QE impact on house prices. QE, of course, goes hand in hand with very low interest rates, which pull down the yields on government bonds. Although QE itself pushes the yields on government bonds up, it nevertheless coincides with periods where monetary policy is extremely easy. And you can see now that US mortgage costs, which are represented by the 30-year Treasury bond yield, which is the blue line, these are extremely low compared to the level of personal mortgage interest paid as a proportion of mortgage debt, which is the grey line, and therefore this represents a fantastic, or has been representing since COVID struck, a fantastic opportunity for the average US householder to go out and buy houses. And if we have a look at the next slide, you can see what impact this has had on house price growth. Since COVID and lockdowns, but also a sharp drop in bond yields and interest rates happened, house prices in the US have risen by 34%. Adjusted for inflation, i.e. consumer price inflation, that's a real 25% increase, which is, in just a period of 18 months or so, is an absolutely extraordinarily aggressive rise in house prices, and causes many of the sort of wealth divide and inequality issues that we see stemming from this Fed policy. Now, I'm going to move on to more natural inflation, but I just want you to bear in mind that there's a large part of the story that we're not measuring at all, asset prices that have rampant inflation, and have really had rampant inflation ever since the great financial crisis. So now let's have a look at consumer price inflation, which is the only area that hasn't been seeing rampant price inflation. And one of the things about that, apologies for this, the US house price comment in the middle of that slide, that's an IT quirk that seems to have happened in translation. But anyway, if you look at this slide, this is what we're really looking at as to whether inflation is transitory. The first time that the Fed argued that the inflation was transitory, they were largely talking about base effects. So if you have a look at the black arrow, that's kind of showing you the trend line that CPI inflation in the US was following pre-COVID, around about a 1.8 to 1.9% per annum increase in prices. And then we had the big drop in, we had the lockdown in March of 2020, and that led to the huge drop in economic activity, which particularly impacted energy prices, oil prices, because oil is mainly used for transport in particular. So we had that very sharp drop in CPI caused by the lockdown. And then as the economy started to reopen, oil prices have bounced back, and therefore we saw CPI, which is the blue line, come back towards trend. What's really interesting is that it didn't stop at the trend. It carried on going straight through trend. So if we were looking for merely the impact of base effects, the year-on-year change, plus the trend, we should have seen CPI stop at around about 3.5%, and then drift back down to about 1.9% as we went through the year until around about February, where there was no real base effect to care about. But instead, we've moved on quite significantly from that. So if we think that now the base effects are relatively mild, then we're looking at a situation once we get to February where we should have trend plus the bottleneck price impact, which is something more like about 4.5%. And in the interim, we're going to have figures which are largely probably a bit higher. The next thing we need to think about, though, is what happens after even the supply bottlenecks have cleared. This is assuming the supply bottlenecks do clear. Of course, there are an awful lot of rigidities in the economy, and when you furlough, or in the case of the US, lay off large numbers of workers, not all of them come back, and not all of them come back to the same jobs. So you can find all sorts of distortions as people have given up waiting for their old job to come back and have moved on to another area or another sphere. And when that has happened, then it's much harder for their replacements to be found without having to bid up wages. So there's all sorts of things about bottlenecks which are quite anti-transitory in nature. But that's not the only thing we have to worry about. If you're banking or putting all your eggs in the transitory basket, as the Fed indeed is. And if you have a look at the next slide, you'll see that a very significant problem on the horizon for the Fed is that 1/3 of consumer price index, CPI inflation, is shelter. So that's basically rent of the primary residence or implied rent of your primary residence. They literally have a survey and ask people what they think they could rent their house out for. And on top of that, there's the actual rent component, which is rather small. It's only about a quarter of the shelter component. Now, if we compare what's happened to house prices in the US, which is the red line, you can see that the moment the blue line, which is the shelter and rent component of CPI, that actually has come off and it's down quite a bit from the levels that it was at pre-COVID. It was around about sort of 3.5% year-on-year growth rate pre-COVID, and it's currently only more like about 2.7%, 2.65. But if you look at what's happened to house prices, the big jump in house prices, which we talked about a little bit earlier, that is equivalent to at least a 5%, if not 6%, increase in the shelter component, the CPI. And that is going to be applied to 1/3 of CPI. So even if you had a really quite spectacular unwinding of all the bottleneck, supply bottleneck problems, and everything went back to normal, which it really already doesn't look like it's going to do. But even if you had that assumption built in, you would still also have to factor in the fact that CPI over the next 12 to 18 months, call it 15 months, over the next 15 months, CPI is going to find that at least 1/3 of its components are rising at 5 to 6%. And that, of course, makes the achievement of a prior trend 1.9%, or even a new normal 4% sort of CPI rate, seem to be a reasonably heroic assumption. The other problem with this, of course, is time. We've had inflation looking surprisingly strong ever since we had the year-on-year base rate effect from March of 2021. Now we're talking about CPI being held up by the housing component, maybe up at overly high levels for a further 15 months or so from now. Now that really means that we're really baking into the cake 2 years of sustained way higher than normal and certainly way higher than pre-COVID inflation rates. Now, the really important part about this is that even if you think that the things you're looking at that are causing high prices at the moment, famously people cite things like the very impactful secondhand car prices in the US, which have been driving the last couple of months or so of CPI, and how unlikely it is that this is going to stay significantly high for more than, say, 6 to 12 months going into the future. But the real point of the matter is that if one by one you have all these different component parts of CPI having their turn to be fairly excessively high, then you're going to find that transitory starts to look more and more persistent. And if you have 2 years of strong inflation, then you're going to start impacting people's expectations, and that's going to feed through into wage demands. And even Keynesians would acknowledge that by the time your inflationary expectations are informing wage negotiations, it's probably too late to do much about it. Anyway, this is all talking about the real elephant in the room, which is something that the Fed. There are 8 of the Fed presidents are economics PhDs. There's a large amount of groupthink in the Fed, and they certainly adhere to a very strict neo-Keynesian attitude to money supply, which is kind of ironic given the fact that they're pretty much in charge of it. But if we have a look at the next slide, we can see how impactful money supply has been. Before we do that, though, it's worth bearing in mind that it has long been argued that the Milton Friedman approach of looking at excess broad money supply, which is broad money supply less real GDP, so nominal broad money supply less real GDP, that should give you the excess amount of money supply that wasn't required by the economy. His argument was that that would have a reasonably close relationship to inflation. So here, the blue line is excess broad money supply, and the red line is annual CPI inflation, delayed by 1 year. So we move the money supply first, and then the inflation follows suit, or vice versa. And then what we see here is that there appears to be a pretty reasonable relationship between the amount of money, excess money in the system, and what happens to CPI inflation. This was exacerbated in the oil crises. In both cases, prices went higher than money supply measures, excess money supply measures alone would suggest. But it's worth bearing in mind that, of course, the oil crisis was an exogenous price increase imposed from abroad, from the Arab countries, and therefore wasn't driven by endogenous factors. And then there's the period which is very important, which is the first half, really, of the 1990s. And the first half of the 1990s, broad money supply basically went fairly flat, and therefore, as you can see, excess money supply actually went negative. Even though the economy was growing pretty steadily from 92 or certainly onwards. And this carried on right the way through till certainly to 95, 96 sort of period. Now, this was at a time when there were government restrictions on the amount of interest that you could be paid by a bank. They were trying to basically bail out the savings and loans. And so they restricted the amount of interest that depositors could receive on their deposits. But this was also the time when 401ks had been around long enough by this stage that they were a reasonably familiar, if underutilized, product. And people realized that you could basically put your cash deposits into a 401k, which had no such restrictions in terms of what you could get in terms of interest, particularly if you utilized either treasuries or money market funds. So there was a $1 trillion increase in 401ks. Actually, I think it was more than that. It was more like about 1.3. And there was that mirrored the amount of the gap that had opened up between broad money supply and the economy if they carried on moving together like they had before. So it appears very likely, if not clear, that households were diverting during the early 90s their savings deposits into their 401k accounts. But of course, 401k is not included in money supply statistics, so you had an apparent decline in money supply, or more accurately, it was just a sort of a completely flat line in money supply, even though the economy was growing. And I think this is actually a measurement problem. But what's interesting is it was the period that the Keynesians used to argue that monetarism had broken down, and therefore that the excess money supply growth argument didn't hold water any longer. But I think that this is really just due, as I say, to mismeasurement. Which brings us to a very important point, which is that what is the likely impact, therefore, of the massive surge in money supply? Because the QE that was done in 2020 was largely, in a roundabout way, to make it not too obvious, was largely used to fund massive fiscal transfers. In most US states, the average unemployment, which is paid at the state level, by the way, the average unemployment payment is around about $400 a week. The federal or the feds upped this by $600 to $1,000 a week during the COVID period for all those people laid off during the COVID period. This, of course, meant that people were receiving $52,000 or thereabouts in unemployment benefits, which is way higher than the average wage. So many people who were laid off in the US during this period were actually earning more money by being unemployed than they were when they worked. So if we move on to have a look at how this money growth distortion is representing it or manifesting itself, this is a chart of the real broad money supply. So that's broad money supply. By the way, the Fed stopped publishing M3 broad money supply in February 2006. The Fed has never been very interested in money supply data, and which is unfortunate because the Fed is the one that publishes that data. But luckily, the flow of funds data gives us a way of very accurately measuring money supply. The only problem is it's quarterly data, and it comes almost a quarter in arrears, so it's not timely, which makes it frustrating. But we can illustrate what's happened after the event fairly straightforwardly. So this blue line represents the 6-quarter change in real broad money supply in the US. And the first thing I would say is that you can see that the increase in broad money supply in the red ellipse is way higher than anything we've seen historically, or certainly in the post-war period. So the consequences of this are likely to be either nothing, according to the Fed, or quite significant, according to what I'm about to argue. But the other point I'd make is that, generally speaking, there is a sweet spot of money supply growth. It appears to be a sweet spot, which is sort of somewhere in the high single digits. When you deviate from that, either too low or too high, we tend to have serious events. So if you go too low, if real money supply growth goes negative or close to zero, we tend to get recessions. These presumably are deflationary recessions. But likewise, if you look at the recessions where money supply growth was quite high, i.e. 1982 or 2001 or 2009, there also appears to be a sort of inflationary bust risk here as well. So the consequences of allowing excess volatility to leach into your money supply growth appears to be a disruptive recession, whether that excess volatility of money supply is too low or too high. If we look at the next slide, we can look a little bit more closely at what's going on when we have a recession. So these green ellipses show all the recessions, which you can see are almost all of the recessions. It's the 1974 oil crisis seemingly was not party to this idea. But if you look at all the other recessions, what you see is the blue line, which is total household deposits, and the red line, this is percentage change, and the red line, which is the deposits of businesses. And a recession is not usually accompanied by a decline in household deposits. It was in the consumer recession of 1990 to 92, but normally speaking, a recession is when the consumer, for precautionary reasons, holds back from spending. So the consumer household deposit growth is maintained at a reasonably high level, but it's firms' deposits that really take a dive. So when consumers stop spending, business deposits, which is the red line, they're the ones that tend to dive into the red. And this is highlighted by all of these green ellipses. Now have a look at the faux recession that we've had in the early part of 2020. It's normally the case that to declare a recession, you actually have to have 2 consecutive quarters, but they've made an exception in the case of COVID, and it's really only been 1 quarter. So technically, it's not even really a recession, but you can see, although the depth of it was, but you can see that unlike normal recession, not only did household deposits shoot up, the growth being higher than any time we've seen in the post-war period, but we also saw business deposits rising during this period. And that's just never seen really in a recession at all. It's almost counter to the definition of a recession, which is that people stop spending and firms therefore have a sharp drop in their bank deposits. So we have created a very substantial excess of money supply through, for firms, grants from the Treasury, and for households through these very generous unemployment, and indeed just general checks that have been sent out to each household as well. So the increase in household deposits since COVID struck is $3.3 trillion. To put this in perspective, the US GDP is about $21 trillion. And the increase in non-financial business deposits since COVID struck is 1.1 trillion. So we're looking at around about 4.5 trillion increase in household deposits. This is equivalent to a good 1/5 or so of the size of the US economy. This is just an increase in household deposits. And at the moment, those deposits, household and business deposits, and at the moment, those deposits are just sitting there in bank accounts. So if we look at the next slide, it illustrates that the way that we've opened up this gap between the economy, which is the red line, that's GDP, and the blue line, which is broad money supply, which is basically currency in circulation, plus household and business deposits, plus proto deposits that those entities use, like, for example, well, mainly money market funds, but also tripartite repo. So what you can see is that, normally speaking, there's a reasonably close relationship between these two things, which is another way of saying that for any level of GDP, the economic participants have a sort of fairly reliable and steady demand for money balances. And we've suddenly massively distorted, I say we, the Treasury, US Treasury, funded by the Fed, has massively distorted this. They've boosted deposits so that there's a massive gap now between nominal GDP and nominal bank deposits. And the Fed subscribes to the Keynesian theory that because this increase in deposits was caused by what they call exogenous money, i.e. By the monetary authorities, as opposed to endogenous money, which is growth in money supply from commercial bank lending, that this money won't be spent. As a consequence, we've got an argument that says that households and businesses will just sit on this money as if their precautionary incentive was semi or even fully permanent. If this sounds like a stretch, then that's a worry, because this is pretty much the entirety of the Fed's transitionary argument, that inflation has to be transitory, has to be based on base effects and more recently supply bottlenecks, because it definitely isn't going to be fueled by this money leaving these bank accounts and being either invested or spent. If you have a look at the next slide, we can look at this from a more economic point of view, if you like, which is the velocity of money. So using the Fisherian equation of MV equals PT, we can, the residual of the relationship between broad money supply and nominal GDP is the implied velocity of money. Now, all sorts of confusions arrive when you don't use a proper long series of broad money supply. M2, for example, is only part of broad money supply. So here are the flow of funds data based money supply going back to 1950. And you can see that over the last 70 years, there's been a pretty decent, recognizable and fairly unvolatile trend in the velocity of money. The only noticeable big lump being that 401k distortion in the mid-90s that we discussed above. So therefore, we've never really had a significant move away from the trend in velocity until now. And any serious movements in the past have reverted to trend. Now, if we were going to get a reversion of trend in terms of velocity now, we would be talking about something like a 20% or so increase in nominal GDP. A very, very substantial impact. There's no reason to assume that much of this would be would influence real GDP. We're talking about a properly stagflationary type situation where this is going more likely to be impacting prices than it would be in terms of real growth. So before we even see these broad money supply balances moving, we're already seeing what the Fed was initially confident was transitory inflation dragging on and remaining surprisingly, at least to the Fed staffers, strong. And the likelihood is that we're going to continue to see this. But really importantly, we haven't really seen the reversion in the velocity of broad money supply yet. When that happens, if that happens, then we're looking at a substantially more inflationary potential. Now, apart from that, there's also several other things which also happen to be on the cusp of threatening quite an inflationary environment. And if I look at the next slide, one of the things which I think has been significantly overlooked is the condition of the US banks. So it's worth bearing in mind that US banks have now something like about 3 times more capital than they had before the financial crisis. I say something like because the way capital was measured pre the crisis was allowed capital to be inflated by all sorts of regulatory rules. For example, banks could inflate capital by including deferred tax assets, by including intangibles, by including prefs, which are bonds. But the real fact of the matter is that, so therefore, when we sort of changed under Basel II and Basel III, the definitions of capital for the banks, what used to be called Tier 1 capital is now quite different in terms of its components to what was then called Tier 1 capital. However, the IMF did do a calculation where they estimated that US commercial bank capital was probably about $560 billion in the summer of 2007, just ahead of the banking crisis. So on that basis alone, we can say that US banks have pretty much 3 times more capital now than they had then. This has also been manifest in the way that the components of their balance sheets have changed. So if you look at the blue line in this chart, this is loan assets that the banks hold as a proportion of total assets. These historically used to be around about 2/3 of total assets, about 67%, but they're currently down at, in fact, I think they've just touched 50%. So there's been a massive decline in loans as a proportion of total assets. This isn't actually loans declining, this is total assets going up. And the driver of the total assets going up, which is the red line, is cash. This is mainly, cash is mainly bank reserves held at the Fed. And that, of course, is caused by QE. So QE has loaded the bank's balance sheets up with risk-free reserves or cash balances. They used to be about 20 to 25% of total bank assets, and now they're well in excess of they're about 37, 38% of total assets. So banks are not just more well capitalized than they've ever been in history, they're also more liquid than they've ever been in history. There are still high quality liquidity asset rules that the banks have to adhere to that keep pushing them into having more and more liquid assets. But the fact of the matter is that if you're a banker now, you see that loans are a record low proportion of assets and capital is a record high proportion of assets. And that creates a massive incentive for any banker to increase lending. You're not going to get very far trying to increase lending right now to a household sector and a business sector, both of whom have found that their bank deposits are absolutely awash with cash. But as soon as reopening properly kicks in, there's going to be very little restriction to prevent. And we've already seen a lot of bank lending, of course, in the mortgage space. So if we look at the next slide, how imminent might this be? So here we've got a 1-year lag in the relationship between bank loans and which is the blue line, and the number of domestic banks which are tightening standards, which is the red line. Now the tightening standards line is on the right-hand axis, and that's been inverted. So a sharp spike that we've seen in the last 12 months in the red line is not domestic banks tightening standards, that's actually a record loosening of standards. The way the survey is done, this does not mean that bank standards are at a record loose level. It just means that more banks are loosening standards 40 more banks for every bank that isn't are loosening standards, 40% I should say, right now. So we've got the beginning of what looks like a very good potential for loan growth. Historically, we'd be looking at maybe 15% loan growth. The only time this didn't really work was post the GFC, when the banks were in resolution. So of course, what's actually happening in resolution is that the banks are actually net of their losses from bad loans. If they crystallize them, they would have hardly any capital, or maybe negative capital. So at the time of the resolution period, banks were artificially restrained from increasing lending because their balance sheets had not been fixed. That is not the case now, quite the opposite. So there is a very good chance in the next 12 months that US bank loan growth really takes off. The only obstacle really to taking off is the fact that it's hard to find anyone who requires credit when their bank accounts are sufficiently full. So the argument really on the transitory front was originally based on base effects. It then has moved on to incorporating supply bottlenecks. But it has completely ignored, A, the problems that the supply bottlenecks will cause in terms of structural rigidities. It's completely ignored the impact that we're seeing already in CPI in being too high. But the most egregious problems are that CPI will continue to be held high for the next 12 months because of the impact of rising house prices on the housing component. And then we move into the really dangerous zone, where not only do we have an excessive amount of money supply growth that has been artificially restrained from pouring back into the economy by lockdowns and other non-pharmaceutical interventions, but we also have, on top of that, the fantastic scope for an aggressive loan growth pitch by the banks. So these are all still to come, and they're all going to compound the pain for central bankers, both in the UK and the US, who believe that prices and inflation are merely a transitory issue. And I'll end on a slightly jaundiced or cynical point on my final slide, which is that historically speaking, we know that the authorities in any environment are keen to get out of an overly indebted position if they possibly can, without the pain of actually raising taxes or cutting back spending. And there's certainly no sign in the US that the Biden administration is in any way interested in cutting back spending. So the easiest way for politicians to actually square this circle historically has been to default. Not an overt default, but a default nonetheless, via allowing inflation to run hot for a bit longer, or maybe a lot longer than most people expect. So the final thing I'd say is that whilst the Fed and their neo-Keynesian theory purportedly tell them that inflation pressures will be transitory, to them and their way of thinking, if they're wrong, so what? If they're wrong and inflation remains embedded, then that would actually have the added advantage of eroding the real pain of the public debt. So on top of everything else, they are likely to be reasonably restrained in the swiftness of their contra-inflationary actions, all of which I think leads you to the inevitable conclusion that inflation is going to be an embedded phenomenon, not a transitory. Now, I'm sure there might be some questions, and we've still got a reasonable amount of time for them.
Well, thank you very much, James, for your presentation. It's been really clear and indeed very, very interesting.
Well, the main point about QE is that it is essentially printing money in the sense that the point about unconventional as opposed to conventional monetary policy is that is the importance of the counterparty. When you're doing conventional monetary policy, the central bank buys securities off the banks, and in order to make sure it buys securities off the banks, it targets the sorts of assets that the banks, being highly leveraged, prefer to hold, which are very short-dated securities. Hence, we have the money market and the money markets where this activity takes place. QE is a shift to unconventional monetary policy, where the central bank buys long-dated securities specifically because this is after the great financial crisis. COVID's different. I mean, in fact, you would argue that COVID did not require a QE response at all anyway. But after the great financial crisis, the point about QE was that if you keep providing liquidity to the banks using conventional monetary policy, but they have a balance sheet problem, i.e. it's not a liquidity problem for the banks, it's a solvency problem for the banks, then it doesn't matter how much liquidity you give them, that money isn't going to move. And as a consequence, because banks won't lend, look back at my chart before where we were showing that during resolution, bank loan growth was visibly depressed compared to non-resolution periods. So therefore, you needed to, as a central banker, you needed to find a counterparty who was not a bank so that you could expand money supply or bank deposits without relying on bank loan growth to achieve that end. So therefore, if you buy securities of non-banks, you need to buy long-dated securities. That's what Operation Twist was all about, when the Fed realized that in QE1 had been entirely mortgage-backed securities. QE2, they moved into treasuries as well, but then they realized they had bought some short-dated securities. And anything really sub 5 years is probably going to be as likely to be owned by a bank as a non-bank. So they got some kind of free QE out of it by doing Operation Twist and selling off the sub 5 years and replacing them with longer dated securities. So the argument then is QE changing relative prices, or is it inflation? So firstly, Bernanke argued that, or he quipped that QE didn't work in theory, but it did work in practice. What he meant was that it didn't work in his theory. His theory had been that if you buy treasuries, you'll push the price up and the yield down. The Fed so confidently expected QE to cause yields to go down that you can't actually find any Fed-sponsored research to this day that admits that it pushed them up. But it did. If you actually look at the timing and actuality of QE, i.e. securities bought by the Fed, that coincides almost perfectly with rises in the S&P and rises in Treasury yields as well. So, and usually of about 100 basis points or so. Now, why would the Treasury market, if you've got a new massive buyer coming in, why would the Treasury market sell off? The main reason the Treasury market would sell off despite the presence of a new buyer is because the new buyer's actions are telling the Treasury that the story has changed, that we're now going to have an expansion of money supply. But an expansion of money supply, if you're a Keynesian, isn't going to make, especially not one driven by the monetary authority, isn't going to make things more inflationary. So therefore, the Treasury market should not have sold off. According to the monetarists, it's a different argument. Then if you expand money supply, that is inflationary. Therefore, you would expect the Treasury market to sell off. So QE, in many respects, was an experiment to decide who was right, whose theory was right, the neo-Keynesian or the monetarist theory, about what the impact of money supply changes is on the inflation level of the economy. Not actual inflation. This is compared to what would have happened in the counterfactual. And the bond market is the arbiter of that. And the bond market tells you resoundingly that the monetarist view is superior to the neo-Keynesian view. But I wouldn't expect any academics to believe that, because they don't tend to like empirical evidence. Well, there's a famous old Irish joke where someone asks an Irish peasant by the side of the road how they would get to wherever it is they're going to, and the reply is, well, I wouldn't start from here. And I feel very similarly about the Fed. The Fed is walking into this with their eyes completely blinded to what they're facing. QE is unconventional monetary policy, but it's still the same policy that you do when you're lowering rates. In other words, buying securities. The difference is that instead of buying short-dated securities off the banks to increase their liquidity so that they go out and lend and expand money supply that way, what the neo-Keynesians call endogenous money supply growth, that you get instead exogenous money supply growth caused directly by the central bank. So basically speaking, if you're looking at QE is actually lowering interest rates when interest rates are already zero. So to put this in perspective, Bernanke was kind enough to tell us, I do apologize, was kind enough to tell us that in QE2, the size of QE2 was going to be $600 billion, because $600 billion was about what they would expect to spend at the short end in pre-zero interest rate days to lower interest rates by about 75 basis points. So 200 billion per 25 basis points. So when you're doing QE, you're basically lowering interest rates. So as the process of QE is going on, that is policy-wise the process of lowering interest rates into negative territory. So we've got the Fed talking about whether it might look at raising rates at the same time that it is every day lowering rates because it's still doing QE. So this is cognitive dissonance. There's cognitive dissonance with the Fed looking at inflation figures coming out and leaping way above their return to trend, and insisting that it's transitory. How long is transitory? They've never said how long transitory is, but if transitory is long enough to make people think that they better start asking for higher wages, then it's not transitory. And that's already basically seems to be at that level. So the answer to the question is that the Fed should not be doing QE. It probably should never have done QE in the first place. QE is a way to raise money supply when your banking system, when the compression of the banking system balance sheet threatens to create outright deflation, i.e. a shrinkage of raw money supply. There was no such. If the threat was there with COVID, it was there for the first month and the first month only. And as soon as they organized the fiscal generosities, that was never really going to be a risk, and they've massively overdone them. So the answer to the question really is that the Fed should have been raising rates some time ago. Having to continue QE is just madness. To talk about tapering is madness. They should stop QE. They should have stopped QE some time ago. But they're so worried about what I think was their misunderstanding of the taper tantrum that they are worried that there'll be a nasty blowback if they were to cut back on QE. So you've actually got central bankers now talking about raising rates whilst they're still winding down QE. This is madness. The euro area is a little different. One of the reasons I highlight the US is that in almost all things, the US is the extreme case. So the US had the sharpest, but also shortest post-GFC negative experience. The US cleared out many, many more of its banks. If you remember, something like 50% of the household name banks in the US, were absorbed into other banks and effectively went, in their own sense, out of business. Whereas in Europe, we had one or two fairly big banks go under. Dexia particularly springs to mind because Dexia had just, about 2 or 3 months earlier, had just come, I think it was 11th out of over 100 European banks in terms of quality of balance sheet. And then they folded, which told you everything you need to know about the 90 plus banks below Dexia in terms of quality of balance sheet. So the euro and European banks, if you measure it on a like-for-like basis, had way less capital as a proportion of total assets than the US banks. So the Europe area banks have had a long slog to get back to profitability. You could easily argue that US banks were basically fixed and fully resolved by certainly sort of around about mid-2014, certainly by 2015. You could argue that Euro banks still aren't fully resolved now, not in their entirety. And that's why in many areas we've still got very sluggish loan growth because they're still trying to repair their capital after crystallizing losses. So the outlook for the Euro area is much less significantly inflationary, because the banks are not in any position to, or seemingly aren't in anything like a stronger position to for sponsor loan growth. The Euro area is not in the same position because they haven't done, the ECB hasn't done the same level of money supply growth, particularly not in terms of expanding household and business deposit accounts. So you haven't got the wall of money argument. So therefore, I think that the euro area is still, is short term is being impacted by initially the base effects, and now the supply bottlenecks, and a few special problems specific to Europe, like the LNG price. But there doesn't appear to be the same sort of massive wall of money issue and bank loan growth issue that the US is facing. So it could easily be that that in Europe, the euro will outperform expectations, but Europe will not, and inflation is much more likely to be transitory, I think, in Europe. As always, in these discussions, the UK is kind of in the middle. Yeah. It's a sort of it's more like the US than Europe, but less like the US than the US is. The main mechanism that an expansion of money supply should work, it doesn't have to work this way, but the main way that it should work is really, you're debauching the currency. The value of the currency should decline. It's sometimes hard to see that, because if your competitor nations are also debauching their currencies, then they're going to be declining. We also have quite a weird thing in this environment, because we would normally assume that if you create money and increase the money supply, that money very quickly flows to wherever it's going to flow to. But that's because we don't normally have NPIs and lockdowns and other restrictions on economic activity that prevent money flowing from banking deposits into wherever it is that they naturally want to flow to. So we have what appears to be likely a lag in terms of the impact on prices, on currency, and on the economy that money supply will have, compared to any time we might have looked at money supply changes in the past. I think it's one of the reasons why many central bankers and others are downplaying the impact of money supply. They're thinking that if money supply had such a big jump, if it was going to do anything to, say, inflation rates or whatever, it would have done it by now. But I don't think that's a rational thing to expect. So I do expect, because the expansion of money supply in the US is the biggest, I do expect that to put to devalue or dilute the currency, and therefore I do expect the dollar. That's why I said before that the euro would probably do quite well, because it, relatively speaking, is on far less of that, and the dollar will should almost definitely weaken. And if the dollar weakens, then obviously that that means that you're going to get imported inflation added to your woes if you're a Fed central banker, in terms of what's likely to happen to inflation. I mean, the risks to me seem to be so blatantly to the upside in terms of CPI inflation, that if I was a central banker in the US or the UK, maybe let's say Europe, I wouldn't be getting a wink of sleep. But as I said, I mean, look at my last chart. Don't forget that maybe they've got nothing to fear, because after all, what harm could a little inflation do if you massively run up your debts? We are talking about inflation expectations. The reason why inflation expectations is important, because once we know historically, once price rises get into the wage bargaining rounds, then it's historically been kind of game over. So the fact that we're talking about wage expectations means it's already in expectations. So, it's all very well to sort of say, I think it'll be transitory, and I don't think it's going to get into wage expectations or inflationary expectations. It's kind of already too late to say that, if that's what we're talking about. I think there are two components to the answer to that. The first one is that some interesting work done by the Peterson Institute shows that if you want to know what drives or how good a predictor US 10-year Treasury yields are of the next 10 years of inflation, you discover that they're a very poor predictor indeed. The best relationship, or closest relationship, that US 10-year Treasury yields have is the past 10 years CPI. So the first thing to say is that the bond market tends to be very conservative in terms of its own abilities to forecast the future. And so you wouldn't expect on that basis anything in history to tell you that the the Treasury market is good at telling you you're going to get inflation. It's only good at telling you that we didn't have inflation over the last decade. And that's not really a matter for dispute. However, the other thing which I think is probably even more important is that we've had a very muted response by the bond market to the inflationary pressures, but most people don't bother looking at the supply side of the bond market. The money, so the Fed has been buying long-dated securities, 5 and 10-year US Treasuries during QE. But the US Treasury funded itself in terms of its fiscal largesse through cash management bills. So what's been happening is that the Treasury is borrowing short-term and the Fed is buying up their long-term debt. Now, what this has meant is that we actually had a dramatic drop in the amount of available long-term debt in the US. So whilst the Treasury market was facing a deteriorating inflationary scenario, there was far less paper available for Treasury investors to buy, and that shortage of paper artificially propped up the price and kept the yield low. And in fact, we've only just in the last 2 months or so got the level of free float in the Treasury market back above the pre-COVID level. So throughout this entire period, we're scratching our heads, looking at Treasury yields, saying, why are they still so low? But of course, the answer to that is that the supply of Treasuries was artificially massively suppressed. And so as the Treasury Department starts to convert the cash management bill funding that it had into long-dated Treasuries, we are now going into a period where you're going to have a big increase in the supply of Treasuries. Plus, we will have liquidity taken out of the market by the Treasury and into the Treasury General account by the Treasury. So the Treasury will probably, at the same time that the Fed is winding down QE, the Treasury will probably be doing 2 significant bits of damage to the financial markets in the sense of taking money out and putting it in its deposit account and demanding to borrow more money at the long end from the Treasury market. So we, in 6 to 12 months' time, we may be having the opposite conversation. Why did Treasury yields, having stayed so low for so long, then suddenly go nuts? But the upside risks on Treasury yields, I think, is very significant and very worrying. And the Treasury market is one of the smartest markets in the world. So the Treasury market must be pretty good at being sure that it's lousy at predicting things. But if the Treasury market isn't trying to predict inflation, then we shouldn't be using it as our guide.
Yeah.
Firstly, the central bank's remit is not only put to hit their CPI target. In the US, it's also to maintain full employment. As far as house prices are concerned, the thing that basically the Japanese discussed doing QE. Now, this is a little confusing because the Japanese talked about did QE, but our QE is not what they did. They started doing our version of QE, which they called QQE, only in 2013. So in the past, when the Japanese did QE, just because that's called QE and our QE is called QE, they are not the same thing. The Japanese stuck to conventional monetary policy. They stuck to buying securities at the short end and providing liquidity to a banking system that was effectively insolvent. And that's why bank lending never took off in Japan. Money supply growth never happened. And why Japan was forced to endure almost an entire generation of subpar growth and disinflation. Now, as far as the central banks, and the reason why they, by the way, that I think it was the central bank governor Shirakawa at the time, who talked about doing our version of QE, i.e. buying long-dated securities, but he argued that you shouldn't do that because it would be a regressive fiscal policy, not monetary policy. And he said, I'm quite happy to do it, but the Diet, that's the Japanese government, the Diet would have to vote on it and tell me to do it. I'm not doing it as a bureaucrat off my own bat. And the Diet never did give him that permission, so until much, much later. Because don't forget, Japan's problems started in 1990. So by the time they did our version of QE in 2013, they'd already been through 14 years of failed policies. Anyway, so basically speaking, if we know that QE pushes up asset prices, shares, and house prices, so does lowering interest rates. So basically, easy monetary policy pushes up the value of all assets because it lowers the discount rate and therefore increases the net present value of any future stream of income. So as a young person, I'm guessing if you're a student, you're a young person. As a young person wanting to get onto the housing ladder, you and all other young people, if you were taught economics properly, should be going out and demanding that interest rates be normalized. There is no evidence whatsoever that QE has had any real beneficial effects historically on, certainly not in Japan in terms of per capita GDP growth or anything like that. So therefore, QE is really about kicking the can down the road and delaying the reset. And all young people should be demanding that we go back to 5% base rates and 7% mortgage rates. And all the old people in the room will be having a gin and tonic now because 7% mortgage rates would have a radical impact on house prices. They'd be lucky if they only halved. Yes, and I mean, I would say that that is already the case and has been for months and months now. You know, the Fed is ignoring the rampant inflation in house prices, the rampant inflation in stocks and shares. It's ignoring anything, basically trying to take anything that goes up in price out of the equation and saying, well, everything else is fine. And so it's ending up with a narrower and narrower definition of what inflation is. The reason why the Fed initially adopted core core inflationary measures, no matter which one you're looking at, was of course because in the two oil crises, we had an exogenous increase in oil prices, which went up a lot, and they made things like that depend on oil, like food, because of fertilizer and transport, also go up a lot in price. But the way that an exogenous price increase, which looks like an inflation, acts in terms of your disposable income is it actually forces you to spend more of your disposable income on staples than on luxury. In other words, it makes you delay or defer spending on non-essential items. And that is exactly what happens in a deflation. Inflation is supposed to make you buy things now before they go up in price. Deflation is where the economy slows down because you're slowing the rate at which you're buying things. So it turns out that an inflation, if the press think it's an inflation because prices are going up, but if it's being caused exogenously by Arab countries raising the price of oil, its impact is actually deflationary. So what they realized was that they were doing the wrong policy solutions for inflation during the oil crisis, and therefore they should strip food and energy, because food is mainly energy dependent, food and energy out of the inflationary figures and see if they're left with something that looked much more like deflation, because if that was the case, then in fact they should be doing stimulatory measures rather than restrictive ones. We've forgotten all that, so therefore we now look at core for what reason? What is the point of looking at core? You know, the rationale is no longer there, but they've forgotten what the rationale was from the old days. This is typical. Look at QE. They've forgotten what the rationale was, and now they wheel it out every time they think there's a slight chance the S&P might dip.
Thank you, James. We have taken enough of your time. You've been very, very generous. Thank you very much for your presentation, for the discussion with our audience. It's been a fascinating discussion, and thank you to all of you, all the viewers from home, for your contribution to the webinar, for your questions. If you didn't have enough about this question, if James was not clear enough, that I think he was, we'll have our annual conference, as I said before, on the 1st of December, precisely on this topic. We have invited academics, professional economists to discuss inflation, whether it will be transitory or embedded, as our speaker, James Ferguson, said today. And you are very much welcome to attend or to follow us online. So again, thank you, James, very much for your contribution. And we look forward to your next webinar in the future. Thank you.